In this video, we're diving into strategies for small accounts and how you can maximize your options trading with limited amount of funds. Now, at the income option, we consider small accounts to have less than 5 lakhs in equity or cash that is available for trading. But we understand, we get it, 5 lakhs is still a significant sum, but our focus here isn't about the size of your account. Strategies have nothing to do with the amount of capital, but risk. It's all about managing risk to ensure you have the best chance of long-term success in options trading. Whether you're planning to inject more funds or increase your trading profits, that's not the point here. It's all about risk. Managing your position size is important since options trading is a game of probabilities. Understanding that options trading is a game of probabilities and math, and I've always advocated this for maintaining small position sizes regardless of your account's total value, and this is crucial, and we'll go deeper into the concept shortly. But as a small account trader, your key priorities should include the following, and we have to be focusing on this. First and foremost is small position size, and we'll discuss this in more detail shortly, but allocating a small portion of your account to each trade is fundamental. Then we have hedged strategies, risk defined strategies, and we have to make sure we avoid at all costs to take naked positions or undefined risk strategies. This is a must to protect your account. High probability trades, so prioritize trades with a highest implied volatility and theoretical edge. So we'll get into that. The IV needs to be high, and that increases your probability as well. And we'll guide you on how to identify these opportunities. And then we'll of course talk about long-term consistency as well. Long-term consistency, in fact, is achieved while making small, high probability trades that align with a specific probability of profit. We'll break this down further. We'll go into details of how this all comes together. To understand position sizing, we need to understand, we need to take a situation where you have enough capital to increase the number of trades in the number of positions in a specific trade. But you should not do that because of the increased amount of risk if you increase a number of positions. Let's have a look at what I mean by that. So I jump into the strategy builder again, and for this what I'm going to do is build a call strategy, okay, a credit call strategy. Now don't worry if you really don't understand the call strategy itself, the spread itself, but just know that it's a combination of selling and buying a call, two calls. So what we'll do in this situation is to go ahead and sell the 19,650 call, and at the same time we will buy, to create that hedge for ourselves, we will buy the 19,750 put call. So we'll buy the 19,750 and we'll sell the 19,650 at the same time for the same strike price. So what it does is it creates this kind of position for us. So this is known as the credit spread, the call credit spread. Now, as you can see, the probability of profit is 68.89. This is one of our favorite strategies, one of the many strategies that we deploy, but something that we really find favorable. But 68.89% is the probability of profit, but that's not really what I want to look at. You see, your maximum profit is 1,120 rupees. But for entering this trade, I need a capital of just about 25,000. Now, if I have a lakh of rupees as my capital, I can buy four such strategies. So I can buy four of these, or I can enter four of these credit spreads. But you'll notice that my maximum loss is at 3,880 rupees, or almost 4%, 3.8% of my capital of 1 lakh. So by increasing the number of units or number of spreads that I buy to 4, I'm increasing my risk from 3.8% to almost 16%. Okay, and that's what we're doing by controlling your position size. Depending on the size of your capital, you want to select strategies, one that allow you to start with a 1 or 2% risk on your 1 or 2% of your capital as risk,
the amount that you are going to lose per trade. And as you grow, you want to keep that below 4%. Okay, depending on the strategy that you are deploying, depending on the probability of profit, right? It's very easy to say, oh, I have 1 lakh in my account, I can buy 4 units of this strategy. Don't do that, because that's also increasing your risk. And when you do the math in terms of risk planning, something that we do, that we will look at in subsequent videos, you'll notice that the whole system then falls apart when you increase the risk too much. Okay, so hopefully that clarifies the position sizing aspect of the first most important part of your overall strategy, that of position sizing and maintaining small position sizes for every trade.
So next we move on to hedge strategies. What are hedge strategies? Hedge strategies are basically where your risk is defined. You don't want to go into a strategy which has got an unlimited amount of risk. So if you consider this risk profile, this is the risk profile of an iron condor. An iron condor basically is a combination of two spreads. So you have spread 1 here, the two strike prices, and another spread here. Right, when you combine this, you form this strategy called the iron condor. Now, why is this important? You see, let's say our market analysis shows us that the market is going to be range bound between these two levels, and let's say this is 100 and this is 120. So as long as it stays range bound between this level, you're making your maximum profit of whatever it is. Right now, but that's not really the point I'm trying to make here. Even if your analysis are completely wrong and the market moves from the current market price here all the way here beyond, let's say this is 70 rupees, right? So if it goes below 70, a move of almost 35%, if it goes that one, you're way out on your analysis, on your market analysis, and it goes way against your analysis, or the market does what it does sometimes and doesn't really go according to your plan, and it goes below the 70 point. Even in that situation, your risk is defined. So you have a defined risk and a defined profit, right? So it goes against you on the downside, or it goes against you on the upside. So let's say it goes to 150 or beyond, it moves all the way over here. Even in that situation, your risk is predefined. Okay, as against that, if you look at this risk profile is of the option strategy called the strangle. Now the strangle is basically shorting at two relatively close strike levels. Let's consider this again, 100 and 120. Now, as you can see, this is basically shorting a put as well as a call. As against creating a combination of two spreads, you are creating a combination of two short positions. Again, that's not important. What is important here is that your risk is predefined. Your profit is predefined. So if your market analysis are right, the price stays within this range of 100 and 120, you make this predefined profit, and that's your maximum profit. However, if you notice these two parts of the risk profile diagram, these are open. So there's no hedge that you have created. There's no risk management that you have come in. If the market does what it does sometimes and it moves against you, then your losses just keep mounting more and more. So as against the first strategy, where your risk was defined, your maximum loss was defined, in this strategy that risk is open. Yes, you'll end up making a little bit more money, but in this situation you'll land up also losing a lot of money. So that's not worth it. It just makes more sense to go in with hedge strategies and keep working on those to get you the returns that you like. The third crucial element for small accounts is targeting high probability trades with high implied volatility. Our market edge comes from identifying and consistently selling high IV setups. These are historically overpriced and give us the maximum margin for error and profit potential. So let's jump into the Opstra platform and see how we analyze and identify high IV setups so that we can get into those high probability trades. And we see this in the builder platform, in the broker platform. If you go under options, we see IV charts, and right off the bat you can see over here the price movement. But down in the lower part, in the second chart, the lower charts, you will see the implied volatilities and the historical volatility. Very quickly, I'm going to look at the year-to-date performance of Nifty We look at other scripts as well, but very quickly on the Nifty, this is the implied volatility in orange, and likewise this is the historical volatility in the purple. And as you can see very quickly right over here, the orange is much higher than the purple line. So this is the orange line, this is the purple line, and if I move it out, you can see that it always stays above the purple. The orange is always above the purple. There are times when it does cross over, like right over here, but then it does come down over here, implying that basically the market's anticipation or best guess as far as implied volatility is concerned is lower than what actually lands up happening, the historical volatility. And you'll see this not just in Bank Nifty, but also in not just in Nifty, but also Bank Nifty, for example. The same thing happens. You have the implied volatility at this level and the historical volatility at this level, staying lower most of the time and crossing over sometimes, but mostly it stays. The historical volatility stays below the implied volatility. Again, so showing that the market's anticipation of volatility is usually higher than the actual volatility that happens. Same is true for other stocks as well. Let's look at ABB just as an example. So you have the implied volatility again in the orange and the historical volatility in the purple. Again, staying lower, historical volatility staying lower. Yes, there are times like over here, where it crosses over, but as you can see, it quickly comes in, and more than 70% of the time, historical volatility stays below the actual volatility.
Now, achieving consistency in trading is a question that I get very often, and it boils down to being both persistent and consistent. You can't have one without the other. So let's start with the law of large numbers. This is a statistical concept stating that your sample size grows, that as your sample size grows, such as the number of trades that we take, the mean or average outcome will get closer and closer to the expected value of the whole population. In very simple terms, the more trades you make, the closer your results will align with your targeted probability. So to illustrate this, consider the example of flipping a coin, which we often use in our coaching and in our webinars. When you flip a coin, there's a 50-50 chance of it landing on heads or tail each time. Let's say you start flipping the coin and you get a series of heads, and more heads. You might think that something unusual is happening, but remember, if it's a fair coin, eventually the number of heads you get will be balanced out by the number of tails. To demonstrate this, we ran a case study using a random number generator. After the first 4 coin tosses, we only had one head. If you relate this to options trading, it's like making 4 trades with a 70% chance of success and having only one winner. Many traders might conclude that it's not working, there's something wrong with the strategy, or there's something wrong with them. However, the key takeaway here is that consistency in trading comes with a larger sample size. After 100 flips, we ended up with a 64% winning trades, which is better than the 50% expected for heads. And after 1,000 flips, we had 582 winners. Right, this is 58.2%. Still slightly better than expected. And finally, after about 10,000 flips, we had 4,989 heads, or almost 50% probability or average. So the reality is that the more you trade, the closer you'll get to your expected probability, whatever it may be. Now, we can relate this concept to your trading as a probability scale. It's essential to understand that even if you have a high probability strategy, you can still experience a string of losses in the short term. But over a large sample size of trades, your results will converge towards your expected probability. So the key to consistency in trading is not just about individual trades, but about the cumulative impact of many trades over time. So stay persistent, stick to your strategy, and let the law of large numbers work in your favor. It's a fundamental principle in successful trading, and you can see this happen even in a randomly generated file as well. At the income option, our target is typically around a 70% win rate, which we found to offer the best risk-reward ratio historically. So it also balances the risk versus reward. It also balances, overall gives us a good overall performance. So when your goal is to achieve a 70% win rate or any specific win rate,
here's what happens with your trades over time. So imagine this chart represents your trades, and this point in the middle is your target win rate. Let's say it's 70% in our case. Now, as you make more trades, the higher the probability that they will cluster around this target. So let's say this represents a 50% rate and this area represents a 90% rate. So this is, let's say, 50% and this is 90%. Okay, so what will tend to happen is that initially, as you start trading, you might experience some variability. Your first trade could be a small loss or not as profitable as expected. The next trade might be better, even a significant winner. However, the following 2 trades could be losers. After just 4 trades, you might be thinking that your strategy isn't working as intended. But what happens is that as you continue making more trades, you'll see the distribution of your results becoming more consistent around your target win rate. So the more trades you make, the higher the likelihood that you will align with your expected probability. You'll have some outliers, like one exceptional winner, right? Or a significant loser. But the majority of the cluster will be around your target win rate. The insight here is that the law of large numbers comes into play. The more trades you execute, the more likely your actual win rate will approach your desired target. This is why trade size and high probability are crucial for smaller accounts. It's essential to make enough trades over time to let the probabilities work in your favor, just like a coin flip that approaches a 50-50 distribution over a large number of flips. Additionally, by maintaining a reasonable trade size, you ensure that one individual trade doesn't wipe out your account. Risk management is also the underlying, the fundamental mantra as far as options trading is concerned. So your consistent success in trading hinges on maintaining your target win rate over a series of trades. So focus on high probability trades and control your trade size, and over time the law of large numbers will increase the likelihood of hitting your desired win rate. You have to place enough trades over time, and that really gets the whole system working. If you have any comments and suggestions about this video, please do leave in the comment section below. If you like this video, please do forward this to others who you think might benefit from this. At The Income Option, it's our stated mission to help 10,000 people just like you get into options trading and create that passive income for themselves. So spreading the word is one way of achieving that goal.